Business Data Analytics, December 2022, question 22, Financial Management. Now the question reads, Mrs. Jane Wakwa is the managing director of Vuma Limited, a company that makes and sells electronic devices. The company is considering the launch of new mobile phone model branded Trex. The available data is not fully reliable, though Jane still feels that she can make a recommendation on whether or not to launch Trex. Now, additional information. Trex is estimated to have a useful life of 5 years, commencing the year 2023. Trex will require the purchase of a machine at a cost of 100 million at the end of the year 2022, after which the machine will be sold for 20 million at the end of the 5th year. Selling price and cost structures of Trex for the first year, which is 2023, are expected to be as follows. So you can see the selling price all the way to incremental fixed cost excluding depreciation. So there are some inflation rates that have been adjusted here from 2024 onwards. Number 4, the company is eligible for capital allowances, that is depreciation for tax purposes, at 25% on reducing balance. At the end of the project, when the machine is sold, any gain or loss on disposal will be considered for tax as well. The tax rate on income and capital allowances is at the rate of 30% per annum. Then assume that the tax for a given period is paid in the same year. The project will require an initial investment in working capital of 20 million, which will be increasing by 5 million at the end of each year to cater for general inflation. The whole amount, together with the periodic increase, will however revert at the end of the project. Now, number 8, experience has shown that demand for new product is not exactly known in the year, but tends to be stable thereafter. Jane has come up with the following estimates of demand for the year 2023. So probability and expected sales in the year 2023 can be seen. Now, Jane expects an initial increase in demand for the year 2024 of 25%, then a decline of 50% in the year 2025. This level will remain the same till the end of the project, the level of 50%. Now, Vuma Limited has a real weighted average cost of capital of 8%, and general inflation is expected to be 4%. Then, due to the risk of the project, Jane feels that the relevant nominal WACC should be increased to 3%. Required, the weighted average cost of capital to be used to evaluate the project, that is 2 marks. The relevant cash flows of the project period, during the project period, then NPV of the project, and advice on the viability of this project. So this is the question with the part A. This part A of the question, and they are saying the weighted average cost of capital to be used to evaluate the project. That is the one that will be used to evaluate the. Now, to get this, it is just in additional information number 9. We use additional information number 9. You start with real WACC. So real weighted average cost of capital. And real WACC was given as 8%. So that is 8% real WACC. Then general inflation will be added. General inflation. Now the general inflation is 4%. 4% general inflation. Then riskness of the project. So adjustment for risk. Adjustment for risk. Adjustment for the risk. They are saying, due to risk of the project, Jane feels that the relevant nominal WACC should be increased by 3%. So this one is 3%. You increase that by 3%. Then WACC that you are supposed to use to appraise the project will be the summation of all those 3, which is 15%. So that is 15%. Now, relevant cash flows. Relevant cash flows, and the first cash flow that I want us to get is the initial cash outlay. So start with Roman 1, initial cash outlay, initial cash outlay. The initial cash outlay is the first relevant cash flow, and that has been given at the top of the question. You can see they are saying that Trex is estimated to have a shelf life of 5 years commencing 2023. Then it will require purchase of a machine at a cost of 100 million. Purchase of a machine at 100 million. So we have purchase of machine, purchase of machine, purchase of machine. Now the purchase of machine will go at 100 million. That is 100 million. 100 million. Then additional information number after that, the machine will be 100 million, then the machine will be sold at 20 million at the end of the 5th year. So that is the salvage value. So move to additional information number, there's somewhere where they have talked about injection of working capital. Injection of working capital. Number 7, the project will require an initial investment in working capital of 20 million, which will be increasing by 5. So it's 20 million at the beginning, 20 million. So investment in working capital, investment in working capital, 20 million. 20 million. This can be moved. This can also be moved. Now total is 120. That is total initial outlay will be 120. So this is depreciable, the one that is subjected to depreciation. Now after that, we move to the second part, Roman 2. That is Roman 1, then now Roman 2. Investment in working capital. Investment in working capital. Investment in working capital. Working capital. So there is here, then injection. Injection. Then I believe we also have recovery. Recovery. Now additional information number 7. It will require an initial investment in working capital in year 0, which I believe is 2022. Then this will be increasing by 5 million at the end of each year to cater for inflation. Then the whole amount together with the periodic increase will however revert at the end of the project. Remember, the initial year is 2022. So we have 2022. 2022. That is the initial year, year 0. Year 0 is 2022. This second one is 2023. Then now you add for 5 years plus 1. This one should be 2024 all the way to 2027. Now it's from 2023 to 2027, and the initial investment in working capital is 20, equal sign negative, 20,000. 20,000. Then they say that it will be increasing by 5,000, 5,000, 5,000 in additional information number 7. After the initial 20 million, this will be increasing by 5 million, 5 million, 5 million to cater for inflation. So this is 5 million. Same. then drag across because it becomes 5 million all the way to 2023, 24, 25, and 26. Now in note 7, they said that the entire amount, together with the initial investment, so the entire amount, the whole amount together with the periodic increase will, however, revert at the end of the project. So this will revert or will be recovered at the end of the project. So that will be, these are negatives. Forgot that these are all negatives. Then this will be equal sign sum tab. So equal sign sum, equal sign negative sum, all this, because that will be recovered at the end of the project. Enter, becomes 35. Should that be 35 or 40? Because it should cover up to this, it comes to 40. So depreciation charges per year, the depreciation charges per year, depreciation charges per year. So I pick the years, So depreciation, this will be year, the years, then depreciation rate, the rate of depreciation. Rate has been given in note, rate of depreciation has been given. Additional information number 4. Additional information number 4, the rate is 25% on reducing balance. So 25% on reducing, this is 25%, 25%. Now, having said that, we want to calculate depreciation on reducing balance basis. In the year 2023, it will be equal sign. In the year 2023, it will be equal sign. The cost, which is depreciable, is 100,000. 100,000, lock it with absolute cell. Now depreciation for 2023 using reducing balance will be equal sign, open bracket, so equal sign, then open bracket. Click on 100,000. 100,000 is the purchase of machine depreciable. Lock it with absolute cell referencing. Then times, okay, we can close bracket and times. Then click on the rate, then lock the rate as well. So it's 100,000 times 25%. That will give us 25,000. So that is 25,000. Depreciation in the first year. Drag across to 2024, just to 2024. It will be the same amount, but double click to adjust. You double click and say now, inside the bracket, just less depreciation for 2023. The 25,000, that is depreciation for 2023. Enter. Again, drag across, double click, and now less. Something is moving. I ought to have locked the other one as well. So I'll back, delete this, delete that, go to the one for 2024. Also lock this other one, the D72, because it's a constant one, cost minus accumulated depreciation. So also lock the other one. Drag. Now in 2025, double click. Again, continue lessing. Don't delete anything. Just continue lessing the accumulated depreciation. Now this, lock it. Enter. Drag across. Again, double click. Before the bracket, again, minus the accumulated depreciation for 2025. Enter. I did not lock. So you remember to lock this. Then enter. then drag to 2027, double click, then now less the last one for 2026, which is 10,547. Lock if you want, but not necessary. Enter. That becomes our depreciation for those periods. Of course, you need the total. The total will be equal sign sum, and you are summing from 2023 depreciation to 2027 depreciation, then enter to finish your depreciation. Now, third cash flow, Roman 3. Salvage value. Now, Roman 3, salvage value, salvage value, salvage value, and gain on and gain stroke loss on resale. Gain stroke loss on resale. Now here we start with the resale value. The resale value. Now the resale value has been given. Resale value has been given as go to additional information number 1. Now after which the machine will be sold at 20 million. So it will be sold at 20 million. There's a 20 million there. So you scroll and just write 20. Remember I'm truncating into thousands, so 20,000. 20,000 less book value. Book value. Now on book value we have cost of machine, the cost of machine. Now cost of machine has been given as 100,000 up there. The cost of the machine is 100,000. Then less accumulated depreciation. Accumulated depreciation. And the accumulated depreciation is equal sign, then negative, click on the 76. The summation of all the depreciations are here. Summation of all the depreciations. Then get the book value, which will be equal sign sum. These two, you're getting 23. It needs to be a negative because you're lessing 23,730. Now compare resale value of 20,000 and the net book value of 23,730. That becomes a loss on resale of machine. Loss on resale of machine, which is a loss 3730. That becomes 30. Additional information number 7 again. Number 7 said, not 7, 5. At the end of the project, when the machine is sold, any gain or loss on disposal will be considered for tax. So any gain or loss on disposal will be considered for tax, and tax is 30%. You can see the tax is 30%. So that's what we do here. Bring in the tax rate. The tax rate is 30%. Then tax saving on loss on resale of machine. Loss on resale of machine will be equal sign 3730 times negative. Then you click on this 30%. Now it's a tax saving because it's a loss on sale of machine. If it was a gain, then it will be a tax expense. Next one, demand projections. Demand projections. Demand projections. Demand projections. Now move up to note 8. Copy this. All of this. Note 8 talks about those demand projections. Those are the demand probability of demand. And the question said that in additional information number 8, demand for the new product is not known, but for 2023 will be as follows. So we have demand projections for 2023. That needs to be, this is for 2023, that way. So here, the demand projection for 2023 will be as follows. So there is year, and how that will be happening. 2023, 2024, 2025, 2026, then finally 2027, alongside their demand projections. Now for 2023, so year projection, go for 20. Year projection, then units or demand. This should be demand in units, the demand in units, the demand in units. Now for 2023, you use the weight here, the probability that you've been given on the other side. But for 2024, you can move up. There's something about 2024. Jen expects increase in demand in the year 2024 of 25%, then a decline of 50% in 2025. Then that level will remain the same till the end of the project. So plus 2025, this will be plus 25%, plus 25. Like 50% minus 50%, then constant. The other level will remain constant till the end of the project. Or you can as well just say equal sign 25%, then this is equal sign negative 25, negative 50%. That way. 2023, that will be equal sign bracket. The probability is 30, times expected sales, which are 40. But before I do that, I want to truncate the other side. So I'm cancelling this. Things have been truncated. So I want to truncate this. Let us use truncated amounts. Here write truncated. So if this is to be truncated, you divide with 1,000. We divide with 1,000. So I can as well just so make sure to truncate this. 40 instead of 40,000, it's 40, just divided with 1,000. Instead of 30,000, it's 30, divided with 1,000. Instead of 10,000, it's 10, because we divided that with 1,000. So truncated. The other initial ones were 40,000, 30,000, and 10,000, but we simply truncate into 40, 30, and 10. The projection in the year 2023. So these are demand projections for 2023. And this will be equal sign bracket 40, or you can take 30% times 40, close bracket, the weighted summation plus open bracket, 40 times 30, close bracket, plus, open bracket, 30 times 10. So that is the demand projection for the year 2023. The year 2023 gives us 27. In the year 2024, it will increase by 25%. So this will increase by 25%, which will be equal sign 27 times, open bracket, 1 plus, then click on the 25. Click on the 25, then close bracket and enter. That goes to 34. 34. So 2025, it dropped by 50%. That will be equal sign. Click on 34 times, then open bracket, 1. I will still add because mine is negative 50%. If yours is positive 50% up there, you less here. You're supposed to use minus. But since mine is negative 50, I'll just add, then click on 50, close bracket and enter. That becomes 17. Of course, into 2 decimal places, it is 16.88. Finally, the other one will be constant, which means it is 17 and also 17. The question says that the remainder will be constant for 2026 and also 2027. Now, I just want you to copy the selling price and cost structures. Here, we have the selling price and cost structures. This will help us in computing the cash flows. Copy additional information number 3, and you can bring it closer to your final working because it's going to be relevant, these figures. Once you've organized your work well like this, of course, the tables are not relevant in the final answer. Compute cash flows for the year. So compute the annual cash flows. Compute the annual cash flows during the project's lifetime. So compute the project's annual cash flows now during the project's lifetime. During the project's lifetime. Now, how is this done? To compute the annual cash flows during the project's lifetime, we start by having the years. So we have the years. So we have the years from 2023 all the way to the last one, 2023 to the 2027. From 2023 to 2027. 2023. Then demand, the next part that we want to have at the top there is demand in units. Demand in units. Before that, I believe that is truncated. Shillings. Before that, of course, demand, then the other one is the one that is truncated. You can just say 000. 000. Then this becomes the same to the other side. Now demand in units, equal sign, then click on the demand that we projected up here from 27 all the way to 17. Those are the demands for the periods. Demand. Now after demand, give me the selling price. The selling price per unit. Selling price per unit. Selling price per unit. They said 5,000, but from 2024 it will be changing. So this is 5,000, but it will be changing from 2024 with a projection that has been given. So this will be increasing by 2%. 2%. So you get the 2%, which will be equal sign the 5,000 times open bracket 1 plus, then click on the 2% at the top, lock that 2%, close the bracket. So lock the 2% and close bracket, enter, then drag across. That becomes our selling price. Now, second part will be material cost. Material cost. Now, the formula for material cost will be, the first one is 2,000, then equal sign, the 2,000 times open bracket 1 plus, click on the 4%, lock the 4%, close bracket, and drag across. That is material cost. The other one will be direct
Mwalimu,
labor.
repeat material cost.
So same thing to material labor. Material labor. So equal sign, the first one for 2023 is 1,000. The one for 2024 is equal sign, the first one for 1,000 times open bracket 1 plus the 5%, lock that 5%, close bracket, enter. That is for direct labor. Same thing. Then finally, the incremental fixed cost excluding depreciation. Incremental fixed cost excluding depreciation. 500. Remember, all of them are per unit. All of them are price per unit. Price per unit. So that will be equal sign again, the 500 times open bracket 1 plus, then you click on the 10%, the inflation of 10% for depreciation, which will be locked, close bracket, enter, then drag across. Now there is a selling price and we have costs. So I believe I want to negate the costs. So hapa kwa hii material cost, start with the 2,000, just do equal sign, just put a negative on the first one. They will negate all the others, same to direct labor cost, double click, after the equal sign put the negative, that is 1,000, then incremental fixed cost, equal sign negative. For the year 2023, it will change all the others. Now that will give us contribution per unit. Contribution per unit, and contribution per unit is alt equal, enter, then drag across. You sum up, we are summing up, that is the formula, you sum from 5,000 moving down. Total contribution, total contribution, bracket, CPU contribution per unit times units. Contribution per unit times the units times the units. That will be equal sign the 1,500 times 27. 1,500 times 27, 4,500, then you drag across. Is the 1,500 times 27 up there, the number of units. Depreciation. Depreciation expense, you less depreciation expense. Depreciation expense was given, or we have calculated depreciation at the top. The one for 2023 is 25,000. We have depreciation at the top already. It should be a negative because you are deducting. Drag across. that is depreciation expense. Profit before tax, which will be summation for the profit before tax. I want you to less income tax expense at 30%. Income tax expense at 30%. That will equal sign 15,500 times negative 30%. 15,500 times negative 30%. Then drag across. Profit after tax. Profit after tax. So depreciation profit after tax will be summation of this alt equal. You can see the profits after tax have been given. You select these two, then you do alt equal. That will give you the profit after tax. Now to get cash flow, you add back depreciation. Simply add back depreciation. Now depreciation will be equal sign. Depreciation will be equal sign then negative because you want to add. Click where depreciation was, which is 25 for the first one. For the first one, enter. Drag across.
Hi mwalimu, we can't see hapo kwa add back depreciation.
Cash flows. Cash flows. Cash flows means you take profit after tax plus the depreciation, and that becomes our cash flows for the period. Adjustments to be made. One, resale value. Resale value of machine. The resale value of machine. Remember, it will be resold in the last year. That is the year 2027. It will be resold at how much? Equal sign in the last year. Scroll up and you will find 20,000. You can see salvage value and gain on loss on resale. So it's 20,000. 20,000. After that, there is tax saving on loss on resale of machine. The tax saving on loss on the resale of machine, same area, because you use the tax saving. You don't use the loss itself. You use the tax saving, which is now an income, and it's 119. 1,119. 1,119. Then investment in working capital. So there is investment or injection stroke recovery of working capital. Injection or recovery of working capital. Again, we have everything up. We have everything in the second note. You can see investment in working capital start with 2023, which was a negative. Enter. And drag across up to the one that was recovered in the year 2027 of 40,000. Now, once you've done all that, it will give you the adjusted cash flows. Adjusted cash flows for the year. Adjusted cash flows for the year. Alt equal sum from the cash flows up there. Enter, then drag across. That is 15 marks. 15 marks. Now, final part of the question was 2 marks. The final part of the question was to compute NPV of the project and also make an advice. So we move to the last part, the net present value net present value. When computing the NPV, you need the initial outlay, you need the cash flows. So I'm going to start with the adjusted cash flows. These ones are here. Adjusted cash flows. That is the adjusted cash flows over the years. Then after getting the adjusted cash flows, you need the initial outlay and then the rate. So what is the initial outlay? Equal sign. The initial outlay is at the top. That is the first workflow that we thing that we did. Total initial outlay equal sign. And again, you move up to pick the 120. So we have the 120 here as the total initial outlay. Negate it so that it can be a negative figure. So equal sign negative. Work. Our work is equal sign. It's up there. The one that will be used to appraise the project. It was 15%. So work is 15%. 15%. And finally, NPV, the project. Equal sign, then NPV tab. The rate is 15, comma. The values are from 30 to 76. You simply pick from 30 all the way to 76. Close bracket. Add the 120 because it's an outflow. And you're going to get our NPV of 12,056. So NPV of 12,056.
Mwalimu, kindly repeat.
So this is our advice area. You can come up with some place where you can write anything. So say, since the NPV of the project is negative, comma, the new mobile phone named Trex should not be launched. So the new mobile phone not named Trex should not be launched. NPV that was tested in December 2022. You can imagine BDA was just beginning, so not so many students performed well in that question during that sitting. So don't launch Trex. Another one.